This panel encapsulates one of the fastest growing segments within the ETF space and includes blue chip asset management firms who have embraced actively managed ETFs. This panel will be moderated by Michael Prendergast, who I had the pleasure of meeting and getting to know at his conference last month, and who is the ETF product specialist at Ultimus Fund Solutions. With that, please join me in a warm round of applause to welcome our moderator and panelists.
Good almost afternoon. My name is Mike Prendergast, and I head up the ETF product group at Ultimus, and we're a fund administrator, also sponsoring 9 series trusts, in which provides our clients, some of our clients, a turnkey solution of those looking to get into the ETF marketplace. Today we're going to talk, obviously a little bit about the active space, where the trends are going, and how some of these organizations have actually approached, so how have they positioned their organizations to capture this growth. But I'd like to really start off, and we can have the panelists introduce themselves and a little bit about what their companies are doing in the space. Byron?
Good afternoon, everybody. Brian Lake with JP Morgan. I have the privilege of looking after our global ETF business. I'm thrilled I made it into the club today. I almost got kicked out last week when I rode my electric scooter into the lobby, and they told me they weren't allowed here. So I'm already considering today a victory. Obviously, JP Morgan, boutique bank. We've made some headlines recently. The boutique part is a joke. Nobody got that one. And 5th largest asset manager in the world, heavily pushing into the ETF space. We see that as obviously a big extension of our business, and leveraging our active capabilities to do so, which I think we'll talk about in a little bit.
Good afternoon, Scott Kiefer from Victory Capital. Victory is a $160 billion asset management firm. We operate as a multi-boutique with 12 independent franchises, each with their own branding and specialty. In addition to the franchises, we have our solutions team, which I'm one of the portfolio managers of. That includes our ETF platform called Victory Shares. Victory Shares is an $8 billion ETF platform. Our products span about 23 ETFs in fixed income, equities, liquid alternatives, both active and passive. And in addition to my responsibilities on the ETF platform, I'm also a portfolio manager of active strategies. 25 years of experience running large cap growth strategies, as well as a liquid alt product as well.
Hello, I'm Andrew Sarwick. I'm with Exchange Traded Concepts. I lead the portfolio management team at ETC. I joined 5 years ago when ETC began offering portfolio management as a service. We launched that for clients on platform in 2018. We launched a sub-advisory service in 2019. And we're currently managing 59 ETFs, about $4.5 billion. Roughly half and half in terms of numbers of passive versus active funds, about $2.5 billion in passive strategies, $2 billion in active strategies. ETC is among the oldest of the ETF white label issuers, offering full platform services, but also sub-advisory service.
Brandon Clark at Federated Hermes. I've been in the ETF business now for pretty close to 20 years. Started out on the indexing side, went over to the active ETF side. Came over to Federated about almost 3 years ago now to get them into the ETF business. I think a lot of asset managers, especially on the traditional active side, have been looking to get into this space. It's always been kind of we know we need to get into it. We're not quite sure how we're going to get into it. We know we probably don't have the expertise to get into that. So I've done this now twice for active managers, and we've been in the business for about we've launched ETFs about 2 years ago, just about, and happy to answer any questions we have about.
Great. We've seen assets in the active ETF space roughly at the end of April. They're about $385 billion with about 1,025 products that are active in the marketplace. 60 of them coming to market this year. There were 246 that came to market last year. So, seeing decent flows. Last year about $85 billion. So far this year about $25 billion up to, say, the first quarter. So, I mean, the growth is real. We're all experiencing it, and we're definitely seeing the interest. But Andrew, I was wondering if you could just talk a little bit, like, what are the primary benefits around an active ETF as compared to, say, passively managed or looking at a mutual fund or separately managed accounts? Andy?
Sure. The benefits of an active ETF are really very similar to the benefits of a passive ETF. I mean, they include all the benefits of ETFs: intraday trading, lower operating costs or lower administrative costs, easier management of inflows and outflows because everything is either in kind or in creation unit block sizes. For me, I think that one of the biggest benefits that we see from active managers looking to launch ETFs comes down to taxes. The tax benefits of an ETF, being able to do in-kind creations and redemptions, but also custom creation redemptions, which can reduce the required distributions at the end of the year.
Yeah, sure. I'd echo that, and on a previous panel, it came up, which is, a lot of asset managers are getting into this business as a distribution play, or at least they know advisors, the path of travel is advisors moving to ETFs. But the benefits of an active ETF relative to a passive, those kind of central key tenets around cost, transparency, and taxes are key. I would agree that taxes are probably the leading kind of value proposition for why you get into the active ETF business, especially if you have a mutual funds. And just to put a data point around that, if you look at active ETF mutual funds in both equity and fixed income last year, 44% of mutual funds paid out a capital gain versus only 5% of ETFs, active, fixed income, and equity. So you see a pretty large pretty large gap between what's happening in the mutual fund space versus what's happening in ETFs. And from an advisor's perspective, it just opens up opportunities to think about portfolio construction differently. To think about how they're going to asset allocate and location differently, so that now you have this very tax efficient vehicle on maybe a strategy that they've had in the past. They've already used in a mutual fund, but the Achilles heel has always been that capital gain payment. So I think it's really important, and as an issuer, that's one of the reasons why we look at this and why it's important for us to kind of move into that direction.
So, like, we see there's a lot of demand in the marketplace, and how is your organizations, sort of, from what you're hearing from your clients, where is that demand coming from, and how have you sort of positioned your organizations to take advantage of the situation? Let's take that down the road.
You want me on that one?
Sure.
Okay, so we wake up every day thinking about how do we manage money for clients. So very standpoint. A couple proof points on that. We spend about $400 million a year in research, fundamental research, evaluating individual stocks, evaluating individual bonds. We have 1,000 investors around the world that think about what's going into the portfolio. So our starting spot is the investment component of the strategy. And then we think about how do we deliver that to clients. And the fact is that we could be wrapper agnostic. If you want that in a separately managed account, we'll do that. If you want it in a mutual fund, we'll do that. If you want it in an ETF, we'll do that as well. As everybody in this room is aware, the growth of the ETF element of that is significant. So we actually see it as responding to clients' demand. And you put a number on that. Mutual fund industry growing 5-6% a year, give or take. ETF industry growing about 20 to 25% a year, give or take. So client adoption is happening in that space. And so when we start with who we are as a fiduciary manager, and then deliver that through the wrapper of choice that the client is gravitating towards, that's really how we frame that. And I think my fellow panelists actually articulated the benefits of the ETF quite well in that. But so that's our starting spot is fiduciary active management, and then delivering it through the wrapper of choice.
Scott?
I would just echo that. I mean, it starts with building good product that meet market reality, and then you decide what wrapper it goes into. And most of the time, if you have a great product and you're deciding between a mutual fund and an ETF, the ETF is typically, in most cases, the product of choice because it's a better wrapper. And it also then takes market realities and marries it with what is in demand from clients, which is tax efficiency and low cost. And when you can put the two together, that's where you can have a lot of success. So it really does start with building the right product first and then figuring out the right wrapper. And there's a high probability today that we'll launch it in an ETF versus a fund or even a separate account at this point.
Brandon? Yeah.
Yeah, I mean, I would again echo all of that, and I think you know, the probably the one challenge I'll say that as an active issuer coming into the space is there's a perception around cost, right, which is everybody's sub 5 basis points, and it's not active management, right? So I mean, the reality is there are definitely some cost savings. I'm not sure people fully appreciate all of the implied cost savings as well, because we won't get into nuts and bolts around the mechanics, but all things being equal, even if that, you know, tax efficiency that everybody asks about, the IRS in-kinding securities in and out, there's actually still portfolio savings on just that, how mutual funds operate, that will ultimately even lower the cost, which will end up in better total returns. But I do think we kind of struggle on the active side of, everybody sees ETF and thinks, oh, why isn't this thing 5, 10 basis points? When the reality is, I mean, it is active management, right? So you are getting something other than a benchmark. So that would be the one, I think, somewhat headwind that active faces a little bit as people come in. Probably going to be lower because of some structural savings. Maybe a little better on cost implied, but you know, they are not index funds.
Yeah, that's true. We talk a little bit about, you know, coming to market and maybe some of the complexities around that, and we've obviously seen a lot of new folks come to the ETF space and being new to ETFs as well as being a newly registered investment advisor. And you know, as you look sort of at your operating model, you know, especially like Andrew Scott is sort of supporting folks coming to market. Andrew, how does, you know, some folks are looking at a sub-advisor relationship, and so how does that work? What's the importance, or what does a client get for utilizing a sub-advisor trying to get into the ETF space?
Sure. You know, ETC is kind of a different organization. We're a pure white label service provider, so we don't have any of our own funds. We really specialize in helping investment managers, especially active managers most recently, who want to launch an ETF. They generally have a strategy already. Often they're running it in an SMA, it might be running a mutual fund, but they want to know how exactly do I turn this into an ETF. You know, and I'll kind of highlight some differences on both sides and why you might want to consider a sub-advisor. If you're already running a mutual fund, you're familiar with all the 40 Act rules, all of those requirements. You know, but you're familiar with all the 40 Act rules and requirements. But one of the things that we find that mutual fund managers may get tripped up on is how exactly do I deal with the in-kind creations and redemptions? How do I deal with the basket construction? How do I deal with custom baskets for tax purposes? And that's something where we've built some really purpose-driven tools to help do that analysis and help managers who may not be familiar with that. One of the things that I found when I first came to this business, the ETF management side 5 years ago, was that many of the OMSs out there kind of lagged in terms of their capability of handling the creation and redemption workflow. So that's something that we've built some really purpose-built tools for creations and redemptions. If you're managing a strategy in an SMA, one of the things you're probably going to find that the workflow is quite a bit different for executing your trades. A lot of trades in an SMA are being executed through a custodian, or through the custodian for the SMAs. When you're operating a fund, you're operating a pooled vehicle, and you typically need to do trades with brokers in the market and give them up to a fund custodian and settle them DVP at the fund custodian. So there's some operational differences in the way that your trades get executed. So we help people who are coming either from a mutual fund or an SMA strategy to help operate that in an ETF.
And Scott, your organization has a unique role where you're doing both in some cases. Is some relationships. I mean, how do you approach that business as far as helping clients come to market?
We don't really do any white labeling type of product services. I mean, we have one relationship where we have a partner who had a mutual fund business and wanted to start opening up some ETFs. They had their own mutual fund board. They needed somebody to help them with, the implementation of the strategies and getting them launched. So we did act as a sub-advisor there. They liked our strategies actually, so we were able to leverage some of our own IP, but it's their brand, their name, their mutual fund board that oversees the ETFs. Otherwise, our platform is something that becomes attractive as a firm that has some inorganic growth where we acquire a lot of different investment specialties. They come to our firm, they keep their independence, but our platform allows those organizations to launch their solutions in other vehicles. So most of what we're launching in that capacity are really our own brands, our own franchises, leveraging the infrastructure we built around our own ETF platform.
So as you look at sort of the growth, I mean, what's been your approach to product design? You know, you understand sort of what your shareholders are looking for, what your clients are looking for. What's some of the things that you've evaluated, challenges that you've come across as it relates to sort of what products you've considered, and sort of what has been that approach to date as you go through that process? If you want to start off, Grant.
Yeah, I mean, so from my perspective, and you know, Federated has been around for a long time. We've got almost $700 billion in assets. It's not as if we're starting from scratch, and so you know, there is just this. You know, Brian mentioned it's kind of meeting clients where they want to be met, right? They like the wrapper. We've got existing strategies. I think the challenge still is we've got existing strategies that we'd like to get the wrapper on. But for various reasons, whether it's our partner firms and or maybe some challenges around transparency or liquidity, they may not fit in the wrapper. But you know, I kind of joke when we talk about kind of where we're headed on the product side. To me, there's kind of two things. One, you know, we probably don't have thousands of ideas sitting on the product shelf. Otherwise, they would have probably been commercialized at some point in the mutual fund wrapper. So it's like coming up with new ideas is not like it's not easy. You can come up with a lot of ideas. You see a lot of people come up with ideas. You got to figure out how to distribute those ideas. So distribution is key around any idea you come up with. But for me, it's how do we take kind of what we've done, the franchises that we've built, and how do we put them in an ETF wrapper, because there's clearly demand in those strategies. And in some cases, and we found, you know, we recently launched a product a few months ago on one of our biggest equity strategies. You know, the portfolio management team thought, hey, capital gains are not that big of a deal. Now they're starting to learn that capital gains are a big deal, right? They've kind of run with the mindset of we couldn't do anything in that, so it is what it is. Now they're starting to hear from clients. So I think people are starting to understand that, you know, there is some benefit to this wrapper that isn't immaterial. So how do we get products that we have today? So we kind of focus on what do we have today. You know, it's great. We have a very large SMA franchise, so we look at some of those that aren't already in a mutual fund wrapper, institutional sub-accounts. Like we have some ideas there, but we are really kind of looking at what do we do right now, what do we do best in class, and we start from there. We don't necessarily want to stray too far from kind of what we're known for and what we're good at.
Yeah, so I'll add to that. So we primarily do three things. So one is we'll take what we call a substantially similar strategy, something that's already available in the mutual fund wrapper that we think could be compelling in the ETF wrapper, and then we deliver it through that wrapper as well. So we're offering both the mutual fund and the ETF of some investment engine. So for example, if you're familiar, we've got JEPI, which is an equity premium income strategy available in both the mutual fund wrapper and the ETF wrapper. It's the largest active ETF in the world, $25 billion. The mutual fund is $7-8 billion. And so, you know, you can kind of see how that one's played out, substantially similar. The second thing we'll do is what we call variants, or some ability where we harness existing investment capabilities, but we're delivering them in a way that is different than what's already available in the mutual fund wrapper. We've got two active equity strategies, active value and active growth. The tickers are JAVA, JAVA, and JGRO, JGRO. These use existing portfolio managers with extended track records where we harness one or two capabilities, put it in the ETF wrapper, and then deliver it in that way. So the ability to do due diligence, the familiarity with the portfolio manager are kind of tick, and now you're seeing it delivered through the ETF wrapper in that way. And we're going to kind of continue to do some of that. And then the third thing we'll do is what we call kind of innovative new strategies, something that doesn't exist anywhere else, but we think is a kind of good idea and maybe needs to belong in the world. And so, you know, maybe you'd consider this a variant. To us, it was a new strategy. We did JEPIC, JEPQ, which is the equity premium income strategy that I mentioned earlier, but this is on basically a growth basket, or think about the NASDAQ kind of index. And so that's a new innovative capability that doesn't exist anywhere in any other wrapper at JP Morgan other than the ETF. So we're really pursuing those three paths, and it's just a design decision of which one we're going to choose based on, you know, a number of different variables that you can imagine we'd look at.
Scott?
Yeah, I mean, I think we take a very similar approach. When you're launching something that's similar and just in a different wrapper, you do have to be careful that they're not too similar. So, for example, our fixed income team, which is the old USAA Asset Management, now called Victory Income Advisors, 50-year track record of investment excellence in fixed income, mostly distributed through mutual funds. We have since built out a family of ETF versions of intermediate core, a corporate bond fund, and probably soon some things on the tax-exempt side. They need to be different enough. They can't be pure clones, and this may be a topic we get into as well, because that both is an obstacle getting products approved at platforms. Clients and advisors can sometimes get confused by that too. If two different solutions just in different wrappers have different fee structures, it causes some confusion as well. So we do a lot of taking investment excellence that's, again, kind of married with market realities like fixed income being in demand right now, put it in a better wrapper, but try to make it a little bit different. Maybe the weighting schemes are a little bit different, the holdings can be a little bit different, but you're still benefiting from, you know, the active expertise of the underlying manager. And then similarly, we'll look for things that are out of the box and innovative on the fixed income side or on the active side as well. So trying to follow those same kind of two paths.
And, you know, Andrew, as it sort of relates to, you know, the white label, where clients are actually coming to you with sort of ideas, I mean, how do you assist to help facilitate that process, is trying to put sort of their ideas into an ETF wrapper?
Yeah, exactly. As a white label, we're not really originating the ideas. It's an investment manager who comes to us who has an idea and they want to know how to make it work in an ETF. You know, I'll give you a great example of an actively managed strategy. Night Shares, which is a group of funds where we're the sub-advisor. It's on an Ultimate Series Trust. It's an actively managed fund, twice daily trading, and we worked with them to develop a unique workflow so that trades in the morning could be published in the entire street. You know, one of the roles we serve is sort of an outsourced capital markets or a supplement to a capital markets team. And what exactly is capital markets? It's ETF capital markets is basically everything that you need to facilitate smooth trading in the secondary market for an ETF. It means working with the APs, working with the market makers, working with people, end user clients who want to trade the ETF to make sure that they have the information that they need to price it. You know, not every active strategy could necessarily be done in an ETF, but our role exists to be there to help you figure out how to make it work in an ETF and make sure that the market making community has what they need to be able to price it effectively in the secondary market.
Scott, you just talked about, you know, cloning. I guess one option to cloning would be is just maybe convert your existing structure to an ETF. So, I mean, I think obviously there's lots of considerations around that, but you know, have you folks considered? I know obviously JP Morgan has done a few mutual fund ETF conversions, but you know, talk a little bit about sort of the process. I mean, maybe how you got there, but then if you've considered it, you know, what are some of the things that need to be considered as people sort of look through that process?
So we're in the consideration stage. We haven't done a conversion just yet. I think really you can think around there's two things we think about. I think one is the client and the other is the economics. You know, when you look at the client base of the existing mutual fund, if there's a lot of retirement assets, that might be an impediment to wanting to shift it from a mutual fund to an ETF. For us, a lot of our mutual fund assets have come to us directly, so then it's important to make sure that that client has brokerage set up so that they can hold the ETF if you did a conversion. You know, and then on the economic side, you have to think about assets you may lose in the conversion process. You have to think about the expense to do it. You have to think about the fact if you're going to lower the fee, are you going to take a revenue hit and the economics of the fund take a hit in the short term for the benefit in the long term. So there are a lot of considerations that go into it. And then ultimately, you know, it really comes down to whether or not, and this is really for the whole concept of active ETFs, you know, it's the ETF is not going to make a poor performing active strategy suddenly better. It has to be a good active strategy. So first and foremost is whether there's investment excellence and a track record of performance and a uniqueness to what the offering is that comes before you get into the client base and the economics and even considering a conversion.
Yeah, so we did 4 conversions last year. We've got another 4 that we've publicly announced that we'll be doing in July of this year. The way I think about it is, it was a mutual fund, or, said another way, it's a caterpillar. And on Friday night, it goes to bed a caterpillar, and on Monday morning, it wakes up a beautiful butterfly. And the idea is that if you think that there's a brighter future, to Scott's point, for the existing investors and for that strategy to live on in the ETF wrapper, this may be a way to both be efficient with your platform, so you're not creating 2 products, you still have 1 product, you're just putting it in the more futuristic, if you will, or modern wrapper. So less due diligence for some of the platforms, less maintenance ongoing for the issuer. You're able to maintain the track record. You're able to maintain, some of the assets depending on what types of accounts they are in. I think Scott makes a good point around that. So we have done that, and it's something that we'll continue to evaluate where we think it makes sense. But the key is making sure that the strategy does make more sense going on. And what we've seen is actually other issuers have said this strategy is either going to be closed or we could take a chance at converting it, and that doesn't actually make any difference, right? Like if you've underperformed your benchmark for 10 years, the ETF wrapper isn't going to overcome that, and so you have to just be thoughtful about how you might want to be positioning that.
Thoughts?
Yeah, I mean, I would say it's obviously something as from an ETF product development standpoint, you look at everything, right? There's a lot of innovation that happens in the ETF space on a lot of different fronts. Conversions have been one of the newer ones that have recently come about, kind of echoing what everybody said. We have some strategies that would be good candidates for conversions. We have some strategies that would not be great candidates for conversions, whether through direct investment, again, broad distribution across a lot of different channels and platforms, client-based types, but then we've got some funds that, aren't necessarily broadly distributed. They tend to get used by some of our internal funds, so that, those would be good candidates. We have conviction in those because we're using them in other strategies. We could commercialize them in a different way. So, to me, it's, you kind of put on the whiteboard, what are all the ideas we have? What kind of makes sense right now? What do we think from a distribution standpoint we can get out and sell? Because you convert something, bad strategy, ETF doesn't make it good, but even converting a good strategy, not having good distribution behind it, or being able to go out and solicit new business in that, which the ETF world is a little different in dynamics. You got to be mindful of that.
How is capacity restraints of investing in underlying securities? Has that played into your analysis of whether or not the product would work in an ETF wrapper? How have you actually talked about it, and how do you try to address that?
So you've hit our 3 C's, right? So clones, conversions, and now capacity. Those are all things that I think the industry is wrestling with pretty strongly. From our perspective, we have pretty strict, as you'd imagine, risk profiles to making sure that the strategies that we put into the ETF wrapper can grow to be substantially large and not have any kind of closure mechanisms, because there hasn't been a real way where you could close an ETF to new creations. I've got some ideas. Our lawyers have shot me down on all of them, but I'm going to keep trying. And so it's something to think about. But I think if you look at the mutual fund industry as a proxy, let's step back for a second, right? So 40 Act here in the US, mutual funds plus ETF is $30 trillion. The US ETF market is $7 trillion. So you can do the math there as far as the size. It's about 25%, give or take, of the overall marketplace. So a couple things from that, right? First of all, the adoption is still very low. That pie is going to grow, and ETFs are going to grow within it, but it's going to happen for the next decades. This is going to take a really long time, number one. Number two, you can use that other 24 trillion, so 7 trillion ETFs, 24 trillion gets you to the total 31. You can use that other 24 trillion as a proxy for what's happening in the marketplace. What are investors actually doing? One thing is they still own a heck of a lot of active funds, and they tend to like those funds for reasons that we can get into if you'd like to, but that's a proxy for active, right? So we think this active passive thing, and we call this an active panel, but like that's a proxy for what investors are actually doing with their money. They still like active management. And if you think about fixed income, that's a big deal. If you think about some of the strategies that we've seen, nobody ever asked me if JEPI was active. They asked me what the yield is. So, I think we can get out of the labeling of this and more think about like what's the outcome that you're trying to drive in the portfolio. But then the third thing, and to bring us back to the point on capacity, is then you can look at the entire mutual fund world, pull it up on Morningstar, Bloomberg, whatever your data source is, and you can see what the biggest fund is in a different category and use that as success. And then you can look in the category and you can see, well, what's the average size? And so then you're allowed to like gauge, if we had the biggest product in X category, what would that look like in a mutual fund that's existed for the last 3 decades, and use that as an approximation. And then you have to make the analysis of how do we think this space will evolve over the next 5 years? What would be the mitigation issues that we would have to go through if we wanted to evolve from there? And you can look at our existing product range and see exactly what decisions we've come to on those strategies. And there's more to come with that, but that's how we've kind of framed the challenge and thoughtfully kind of attacked it.
It's a topic that is something we're approaching with great caution. Segments like small cap or even EM, you have to consider that at some point you might have to change the objective, increase the number of names, add subcategories to it. It's not something that our active managers would be running these strategies necessarily want to contemplate or think about. So, we have a number of very successful active small cap franchises. Our Sycamore franchise is our largest franchise at our firm. They don't want to be dealing with the potential of having to have a capacity constrained vehicle and having to change the way they go about things. So it's something, if you're going to go into those areas of the market that have less capacity, you better have a plan. The PMs on the active side better be on board. And in some ways it's a nice problem to have, and in some ways the buyer, just like they would in buying any small cap product, might start asking those questions anyway, and it might be sort of a self-fulfilling prophecy in that there aren't a lot of people who want to throw more money into a $5-10 billion small cap product. So these are considerations you have to really take at the time you're launching these products, and for us, we're going to be a little bit more cautious going into those more capacity constrained areas.
I'd agree, and I think you can't close a mutual. You can close a mutual fund. You can't close an ETF. For anybody who hasn't paid attention, closing an ETF is almost a non-starter, and to some extent, we've seen through history, chances things where that has happened. It usually doesn't end well for the end investor. If you look what happens when that occurs, it becomes somewhat of a weird closed-end fund, not closed-end on a redemption, closed-end on new money. Usually, you close it because it's doing well, and when it's doing well, investors don't know that you closed it, which then it ends up, we've seen things run up into the double-digit premiums above NAV, only to snap back to NAV when it potentially opens again. So usually not a great client experience if you try to close a fund. And the SEC definitely does not love it.
Given sort of the leeway now they have with actually more products coming to market, and there's no designation, say, between active and passive. I mean, how have you seen complexity of products coming to market change at all? I mean, Andrew?
Yeah, I would say that definitely since the coming of the derivatives rule, as was mentioned earlier, we're seeing a lot more interest in products that contain derivatives, whether it's swap-based products, option-based products. There are a lot more opportunities, and with that comes a lot more complexity.
And then as we,
I was just going to say, I think you're seeing complex products move into more of a retail type of an audience or packaging, and then it's marketing and education and whatnot. We have some strategies that use some derivatives. It's a little bit of a different education, but it's not a brand new concept. And the companies that do that well have really, we've seen, the innovators and the simplifies create great franchises around taking products that typically might have been viewed as more complicated, packaging them in the way that the client understands, and have great success. So it's not a non-starter. It's something that's, an area we like to get more involved in.
Yeah, I think everyone would agree investor education is key in how to trade ETFs and things like that. you know, how have you sort of being on the distribution side or even looking at investor education, how has that approach changed or is it different for actively managed ETFs?
I'll say it's not different, right? It's pretty much the same. It's the same thing we've been talking about for 20 plus years. What I am kind of constantly amazed by is there's still a large contingent of advisors who do not use ETFs or have not really the concepts or thought about some of the concerns of using ETFs when it comes little simple things like limit orders, right? We've talked about using limit orders for 2 decades, talked about it, the flash crash, August 25th. You go through all those scenarios, but the number of advisors I kind of run into still that don't understand the basics or have maybe never even used ETFs is amazing. Sometimes I feel like that might be, you know, as an active manager who's just now in the ETF business, it's always like your circle of friends who you kind of bring close. It's the people you could have sold to, right? I could have never sold ETFs, so now I just kind of built my circle of friends and clients around that business. But it is interesting. That would be my big thing is that education is still key. Even as an active manager, there's still a lot of people that are kind of still newer to the space. And the worst thing you want to have is a bad experience because typically the advisor, especially if they're new to it, kind of come back to you as the bad experience was on you. We do a lot of things as issuers to try to make sure they don't get that bad experience, but you can only go so far, and sometimes, you know, unfortunate things happen for some clients.
Yeah, I think there's been a tremendous amount of progress in terms of investor education, particularly at a lot of the custodians, you know, the Fidelities, the Schwabs of the world. They really understand much better now how to trade ETFs. There's been a tremendous uptake in terms of the amount of ETF execution that's done via RFQ, much more than years ago. I think it's still important though, and that's why it's so critical to have that capital markets role covered. And make sure that market makers really understand how to price your product so that they can provide that liquidity throughout the trading day.
Okay. Just going to open it up to any questions. In front.
How do you measure the stickiness of the assets? Or has, you know, how would you say the stickiness has been going from, you know, active to ETF product?
Listen, friction in the market has been going down for a decade now, and the ability to switching costs have just gone down quite a bit too. So it depends on the asset class as well. You know, I think our fixed income assets are more, you know, long-term core holdings, and we're going to see some more stickiness there. But you do build products even in active ETFs that are more tactical, and you have to weigh that and understand that that's a risk and something that's going to occur because trading costs are lower, capital gain situations could be different, so it's a definite consideration as well, but that's something that exists across our entire platform as well.
Any other questions?
Yeah, thanks. I'm just curious the panel's thoughts on where fees are likely to go. You know, thank you. Where fees are likely to go. I mean, obviously, ETFs have brought mutual fund fees down to some degree, but it's kind of interesting, right, what you're talking about. Will active ETF fees continue to track down, and will that continue to put pressure on mutual funds to bring them down? So just any way you guys want to interpret that, just curious where you think fees go long term.
Is Allison still in the room? I know she was on the panel earlier. I want to be careful. She's our counsel. So I'll say a couple things about that. So first of all, we're one of the only industries in the world where, and this is the controversial bit, we're one of the only industries in the world where the expectation is that the more in demand you are, the lower your price should be. If it was pouring rain right now and all of you wanted to make it to JFK Airport and you hit the Uber button, what would happen? You would get surge charges that would pay you more because there was more demand for that. Now, that's a good thing for investors. I think the ETF industry and the asset management industry has done an incredible job to take the unnecessary fees out of the equation. So I'm not saying that, but I do think that the price conversation needs to be more nuanced than fee down, you know, asset manager bad or something like that. So that's the first thing I'll say. The second thing I'll say is it's not very often in life where you buy the cheapest thing and it gives you the best result, right? So like if you have like a fund selector that's taking an Excel spreadsheet, sorting by cheapest price and then buying the thing at the top, you need to start over because you're not starting with where you should start. So where should you start? what am I trying to accomplish in the portfolio? What are my goals? Am I trying to get more income? Am I trying to outperform? Am I trying to manage risk? What is the goal that I'm trying to drive in the portfolio? What are now the available funds to me to achieve that goal? Yes, I'll consider some of these products over here, some of these from different issuers, and then make an informed selection on what product you think is going to help you drive that goal, and pay a reasonable price. But if you just start with cheapest, I struggle to think that you're going to get to the right spot on that. Now, all of that being said, I think the industry is evolving. I think that you've seen margins across the entire financial services space continuing to come down. I think that's very good for the end investor. And by the way, I think we work in the best industry in the world. We literally get to help investors meet their financial goals. Like, that's a pretty worthy cause, and I'm pretty energized by doing that. And so I think all fees continue to trend down. I think what we're going to see is more passive, and passive type strategies are going to continue to be commoditized, and that there's not as much value add that can be driven from that. But then as you go up the ladder towards more of the value added strategies, there will be some value that's delivered for that. And you know, asset managers like ours are going to charge a reasonable price for that. So for example, I mentioned JEPI earlier, largest active ETF in the world. It's 35 basis points. Like, if you did a bell curve of funds out there, you would be very towards the low end of costs with that. And so we're thinking very, very thin with where we're pricing things. But we also don't think that everything's 0 or 100. And then maybe just like finishing with this, but you know, what are the 3 reasons that you would go for active, right? Like, we haven't maybe said that yet, which maybe is something that we should talk about. Well, when we talk to investors, they do 3 things. 1, it gives you the opportunity to outperform. Full stop. It gives you the opportunity to outperform. There's still $24 trillion in active mutual funds that are looking for the opportunity to outperform. So that's real. Second, active management can manage risk, right? Like, if the Fed continues to increase rates, what happens to your passive fixed income benchmark? Nothing. It's just going to drift with whatever is happening with issuance or with any of these other things. You can't control duration. You can't control credit quality. It just is what it is. So active management can manage risk. And then thirdly, it can drive an outcome. It can drive an outcome from income, lower volatility, or alpha, all of kind of the above. And so maybe that's a helpful thing to just kind of end that question on, because the question is, what's value for money? And what I'm suggesting is that you can get passive exposure, and that there's a price for that, but it's increasingly lower, or active exposure for those 3 objectives, and there's some value in that.
Any other thoughts before we wrap up? All right. Well, it is 12:30. We are coming in on time. Thank you.